Hello everyone, welcome back to One-to-One Macroeconomics. This is part 2 of Aggregate Demand. Last episode we began aggregate demand by looking at the formula, what each letter represents, and looking in depth at consumer expenditure and investments, which are the C and I of the formula on screen. Today we're going to look at government spending in detail and also net exports. These represent G and X minus M in the formula. If you haven't watched part 1, then I recommend doing so to understand the content in this video more clearly. Before we begin, we'll recap each of the components and what they actually are. C represents consumer expenditure. This is household spending on consumer goods and services. I represents investment. This is firm spending on capital goods, assets that will be later used in the production of more goods and services. G stands for government spending. This is spending on public goods and services by the government. X simply stands for exports. These are goods and services produced in one country, then sold in another. M stands for imports. These are goods and services brought into a country after being produced elsewhere. X minus M together make net exports. This is simply the value of exports in an economy minus the value of imports in an economy. Now we'll look at government spending. This is money spent by the government on public goods and services, such as education, healthcare, and national defense. We aren't going to cover the things that influence government spending and taxation just yet, because this comes under fiscal policy, which we'll cover later in the year. However, we are going to look at the different things that the government might spend money on. Social protection, which includes benefits and pensions. Transport, such as trains and buses. Industry and agriculture. Debt interest, which includes debts to other countries. Health, like the NHS or spending on hospitals and ambulances. Housing and environment. Education, such as schools and teachers' wages. Defense, such as money for the military. These are different things that the UK government may spend money on. You may be asking if all of these things contribute to aggregate demand. The answer is no. Some of these things don't actually contribute to the GDP of an economy, since the government isn't actually buying a good or services. This includes social protection and debt interest. Therefore, these do not contribute to aggregate demand. Now, you may be thinking where the money comes from for the government to spend on all these different things. It comes from multiple sources, which we'll look at now. Some sources include income tax. This is a tax on the income of households. Value-added tax, or VAT, is a tax added onto the price of all goods and services that are sold. Corporation tax. This is a tax on the profits of firms. Some others include excise duties, council tax, national insurance contributions, and business rates. All of these together are referred as tax revenue. Does government spending always equal tax revenue? The answer is no. It is often higher than tax revenue. This is called budget deficit. If government spending is actually lower than tax revenue, then this is called budget surplus. Now we're going to look at the last component of aggregate demand, net exports. Like I said before, this is simply the value of exports in an economy minus the value of imports in an economy. However, we need to look at some key definitions before we look at net exports as a whole. Exports. These are products sold abroad. The value of exports is the total value of all exports sold. Imports. These are products brought from abroad. The value of imports is the total value of all imports purchased. Trade deficit. This is when the value of imports exceeds the value of exports. Trade surplus. This is when the value of exports exceeds the value of imports. Exchange rates. This is the value of one currency in terms of another. For example, £1 equals $2. Price level. This is a measure of average prices across the entire economy. The main factor that influences net exports is exchange rates. The price of a product is different to the value of a product. The value would be the worth of the total amount of all those products sold, whereas the price would simply be the cost of one single item. If the pound gets stronger, this means that we can afford more of a currency. For example, the exchange rate changing from £1 equals $1.75 to £1 equals $2. When the pound increases in value, the price of exports would be more expensive to foreign consumers, since their currency is worth less compared to the pound. This means consumers are less likely to purchase our exports, so the overall value of exports in our economy would decrease. Now we look at the effect of a stronger pound on imports. Since the pound is stronger, foreign goods and services are cheaper, so the price has decreased, which will cause more households to import more goods. This will cause the value of imports to increase. Now we've seen that the value of exports have decreased and the value of imports have increased. Putting this back into the formula, if X has decreased and M has increased, then on the whole, the impact on net exports is that it has decreased when the pound gets stronger. The next change we need to examine is the pound becoming weaker. For example, changing from £1 equals $1.50 to £1 equals $1.20. When the pound decreases in value, foreign consumers will have to pay less to purchase our domestic products, so the price of exports will decrease. This will cause more foreign consumers to import, which counts as our exports, so the value of exports will increase. The pound becoming weaker means that imports will appear more expensive, so domestic consumers will probably import less goods, so the value of imports on the whole will decrease. This overall effect on net exports is that it increases, because X has increased and M has decreased. There are some more factors that influence net exports. Disposable income that is domestic simply refers to the amount of income that a household has. If it increases, households are likely to import more goods from foreign countries, which will raise imports. Another factor is the real disposable income of foreign consumers. If they have a rising income, then they may import more goods from our domestic economy, so we will experience increased exports. The next determinant are exchange rates, which we covered in the previous slide. Trade restrictions may cause difficulty in people being able to import goods from other countries, or for other countries to import them from our domestic economy. Inflation, which is changes in price over time, may cause consumers to import goods that they would otherwise buy domestically. These factors can affect the imports and exports of an economy, and therefore affect its overall net exports. If government spending or net exports were to decrease or increase, then it is likely to have a similar effect on aggregate demand, since they are both components of it. Thank you for watching. We have now finished looking at the components of aggregate demand. Please like, subscribe, and follow our Twitter on the screen.